All right. We've got Petflix, and guess what? They are a streaming video company, but it's not for us, it's for our pets. Now, if your dog's at home while you're at work, turn on Petflix for them, right? That is what Petflix is all about. Now, in year 3, they're focused on improving their price to cash flow ratio. And this ratio is pretty simple, right? We just take the market value or the price per share on the open market, divide that by the company's cash flow or cash flow per share. Now, they give us some information about Petflix for year 3, and then they tell us, well, Petflix has a current market price of $700,000. That's their market value, right? And then it's based on a share price of $20 and outstanding shares of 350,000. So looking back at our formula, we just need to get the market price and then the cash flow. Well, fortunately, we are given the market price. It's $700,000. Now, we could do this on a per share basis or a total basis. It doesn't really matter. So let's just do it on a total basis. So if we have a market price of $700,000, we need to figure out what total cash flows were for year 3. And when we look at the financial information, sure, we have net income of $250,000, but if we think back to FAR, right, remember the indirect method for the statement of cash flows? Well, we have to add back non-cash items, changes in current assets or current liabilities, as well as capital expenditures to get to that cash flow number. Because otherwise, we're not going to have the most accurate cash flow number that Petflix has. So before we can calculate this ratio, let's calculate the cash flow for Petflix. So we're going to start with net income of $250,000. And then we have depreciation and amortization expense. Now, neither one of these actually results in a cash outflow when we record the expense, but it does burden net income. So what we're going to do is add back both of those. So add back $35,000 and add back $15,000, right? That is why they are a positive number. Now, our next item is an increase in current assets. Well, when current assets increases, yes, we have more inventory or more accounts receivable, but that also means we have a cash outflow, right? We've spent cash to get more inventory, or our accounts receivable has gone up and we have to wait for that cash, right? Either way, that results in a cash outflow. So for our calculation of cash flow, that's actually going to be a negative $5,000. However, there was also an increase in current liabilities of $5,000. And when liabilities increase, our cash flow increases, right? So that is why the change in current liabilities is a positive $5,000. So the last item we need to factor in is capital expenditures of $35,000. So think about it, right? When we purchase a piece of equipment, we capitalize it into fixed assets on the balance sheet, and then we depreciate it over its useful life, right? And that depreciation expense, we already determined it's non-cash. However, when we do buy a piece of equipment, that is an actual cash outflow, but that full cash outflow is not reflected in net income, right? Only the depreciation for that year is. That's the whole point of amortizing it and then depreciating it over its useful life, so that net income is not burdened with that full $35,000. However, it is a cash outflow, right? We spent the $35,000 of cash. So that is why it's actually going to be a negative $35,000 impact to our cash flow, right? So that is why it's negative. So after factoring in all of those items, we end up with cash flow for year 3 of $265,000. So just a bit higher than net income, but it is different. So now that we have cash flow, let's actually go ahead and calculate the price to cash flow ratio. So just take $700,000 of the market price or market value and divide by that cash flow for year 3 of $265,000, and we end up with a ratio of 2.64, right? We have to round that just a bit, but 2.64 is going to be the correct answer.